Section 2.1 Understanding Dividend Payout Ratio, Interpreting Dividend Payout Ratio. 2.1 Relationship with Dividend Sustainability. The dividend payout ratio is an important metric in assessing a company's ability to sustain dividend payments over the long term. The link between the dividend payout ratio and dividend sustainability is based on several key factors: retained earnings and reinvestment. A company's ability to sustain dividend payments depends on its ability to generate sufficient retained earnings. Retained earnings are the portion of earnings that are not distributed as dividends but retained within the company for various purposes, such as reinvestment in the business, debt reduction, or building cash reserves. A lower dividend payout ratio allows the company to retain more earnings, which can be utilized for future growth, capital expenditures, or funding unforeseen contingencies. Companies with higher payout ratios have less retained earnings available for reinvestment, which may limit their ability to sustain or increase dividend payments in the future. Cash flow generation. A sustainable dividend policy requires a company to generate consistent and stable cash flows. While net income is an accounting measure, a company's ability to generate cash flows is crucial for meeting dividend obligations. A high dividend payout ratio may strain the company's cash flow generation if its earnings are not translating into sufficient cash inflows. In contrast, a lower payout ratio allows the company to retain more cash within the business, enhancing its ability to meet dividend payments and other financial obligations. Business stability and economic conditions. The sustainability of dividend payments is influenced by the stability of a company's business and the prevailing economic conditions. Industries with stable and predictable cash flows, such as utilities or consumer staples, often have higher dividend payout ratios because they generate consistent earnings. Conversely, companies operating in cyclical or volatile industries may have lower payout ratios to ensure they have adequate earnings retained for periods of economic downturn or business volatility. A company's ability to adapt to changing market conditions and maintain profitability influences its ability to sustain dividend payments. Profitability and profit margins. A company's profitability is a key determinant of its ability to sustain dividend payments. Higher profitability levels provide a stronger foundation for sustaining dividends. Profit margins, such as operating margin or net profit margin, reflect the company's ability to generate profits from its operations. Companies with wider profit margins generally have more room to allocate a portion of their earnings to dividends without compromising their financial health. Conversely, companies with lower profit margins may face challenges in sustaining dividend payments if their profitability decreases. Future growth opportunities. A company's dividend payout ratio also impacts its ability to pursue future growth opportunities. Companies with high growth prospects may prefer to reinvest a significant portion of their earnings back into the business to fund expansion, research and development, acquisitions, or new product development. As a result, these companies may have lower dividend payout ratios to retain earnings for future growth initiatives. On the other hand, mature companies with fewer growth opportunities may have higher payout ratios as they prioritize returning value to shareholders through dividends. It's important to note that the appropriate dividend payout ratio can vary depending on various factors, such as the industry, company size, growth stage, and investor expectations. Investors should consider the company's financial health, cash flow generation, growth prospects, and industry dynamics when assessing the sustainability of dividend payments in relation to the dividend payout ratio. A high or low dividend payout ratio has different implications for investors and the company itself. Here's a discussion of the implications of a high and low dividend payout ratio. High dividend payout ratio. A high dividend payout ratio indicates that a significant portion of the company's earnings is being distributed as dividends to shareholders. Here are some implications of a high dividend payout ratio. Income generation. A high payout ratio appeals to income-oriented investors who rely on dividends for regular income. Companies with high payout ratios tend to offer higher dividend yields, which can attract investors seeking stable cash flows. Dividend stability. A high payout ratio may indicate a company's commitment to maintaining or increasing dividend payments. It suggests that the company prioritizes rewarding shareholders with consistent dividend income. However, it's important to assess the company's ability to sustain the high dividend payout ratio over the long term. Limited retained earnings. a high payout ratio leaves the company with limited retained earnings for reinvestment in the business. While dividend payments provide immediate returns to shareholders, the company may have fewer funds available for growth initiatives, capital expenditures, research and development, or debt reduction. This can potentially impact the company's ability to fund future expansion or navigate economic downturns. Dividend coverage. A high payout ratio implies that a larger proportion of earnings is distributed as dividends, which may raise concerns about the sustainability of dividend payments. It's essential to assess whether the company's cash flows and profitability can consistently support the dividend obligations, even during challenging periods. Low dividend payout ratio. A low dividend payout ratio suggests that a smaller portion of the company's earnings is distributed as dividends. Here are some implications of a low dividend payout ratio: growth and reinvestment. A low payout ratio allows the company to retain a significant portion of its earnings for reinvestment in the business. It signals that the company is focused on future growth opportunities, such as expanding operations, research and development, acquisitions, or strategic investments. The retained earnings can support the company's long-term growth prospects. Capital appreciation. Companies with low payout ratios may prioritize capital appreciation as a means of creating shareholder value. By reinvesting earnings into the business, the company aims to generate higher returns and increase the stock price. Benefiting shareholders through capital appreciation. Dividend flexibility. Companies with low payout ratios have greater flexibility in managing their dividend policy. They can adjust dividend payments based on factors such as earnings variability, cash flow requirements, or investment opportunities. This flexibility allows the company to maintain or increase dividends during periods of financial stress or economic downturns. Dividend growth potential. A low payout ratio provides room for future dividend growth. As the company continues to generate earnings and increase profitability, it can gradually raise dividend payments without straining its financial resources. This can be attractive to investors seeking companies with a history of consistently increasing dividends over time. It's important to note that the appropriate dividend payout ratio can vary based on industry dynamics, business cycle, growth prospects, and investor preferences. Investors should consider the company's financial health, growth opportunities, cash flow generation, and dividend sustainability when interpreting the implications of a high or low dividend payout ratio in the context of their investment goals and risk tolerance.